Alrighty, folks, it is that time where Millennial Mike combs through the weekly comments, the spicy, the good ones, the surprise ones. He brings them up so I can react in detail. I still can't thank him enough for taking the time to go through all of the comments and find the ones that we should go into deeper depths. I appreciate it. I know the audience does. What do you got this week?
Well, we got a couple of different topics, and you're right. I do like to go with spicy comments, especially starting out with spicy comments, because I feel like getting your blood flow going early just makes for a better video overall. So we're going to start with how selfish you are when it comes to interest rates. So this one is from Farsha Godrodi 2836. They say, let's be honest, Michael. You only care for rates to be at 7% only because you want to buy. If it was up to you, you would have rates at 10%, which kind of seems contradictory, but that's what they said. So, Mike, do you want rates to be at 7% because you're just trying to buy, or where do you want interest rates to be?
You know, you could definitely tell when somebody's new to the channel. They'll see one of my videos and they'll just assume I'm some greedy scumbag son of a gun. Hopefully, the true people that have seen more than one video of mine will realize where my heart is at. A, I don't need to buy another thing. I'm good. B, I could buy for cash. Rates don't freaking matter to me. So whatever. But at the end of the day, I want a housing market to go back to normal. I want the average person to be able to get into a home and build wealth. And I believe, unfortunately, given the last 2 or 3 years of crazy markets, that the only way to get there is higher rates for longer. And it's going to suck for a couple of years. But hopefully it doesn't suck for a decade like it did in the 80s. So you can say what you want about me. Your opinion doesn't matter. I think the people that know me know the truth. But yeah, I actually remember that comment and I was like, this freaking idiot. Just some people are just dumb. So congrats for getting me all riled up on the first one.
Well, sticking with interest rates, because it is a very hot button issue right now. You've done a few videos on it. People have left some comments on it. So this one's from Peter Bedford, 2610. He says, will unemployment rising be what finally triggers a Fed rate cut? Inflation's not stopping, though. So will we see stagflation?
Great question, Peter. I think there's a couple of pieces. I would say that I incorrectly wrote off stagflation when Anna Kelly brought it up over a year ago as a possibility. I wrote it off probably too quickly. I still don't think stagflation is the base case, meaning the most likely, but it's non-zero, and it's probably non-zero by a large mile. And stagflation is really problematic for an economy because the Fed's tools are blunt instruments. They can historically fix unemployment or they can fix inflation. They don't fix both well at the same time. They're like competing, currents. So it could get messy. So unfortunately, stagflation is a real possibility. Gun to head, 30%. So non-zero, but not 10, but non-zero. To Peter's first port, I think that's the only thing that causes, other than a black swan like banking, huge crisis, World War III, something nasty that we're not talking about. I think unemployment's the only thing that gets the Fed's attention. And I want to put a number on it because I don't think it's enough just to say unemployment. The latest reading on unemployment was 3.9% a couple weeks ago. I don't think the Fed moves a needle at 4.2. They may start hemming and hawing at 4.5. It might take 5% to catch their attention. So it's meaningful increase. I mean, a full point of unemployment's millions of people. So I think Peter's right. I think unemployment cracking or the job market cracking is the only thing that gets the Fed's attention.
And so far, we haven't seen much in the way of cracking unemployment. In fact, that was, if I remember correctly, correct me if I'm wrong, that was what kept them from defining the 2 negative quarters of growth that we had a couple of years back as a recession. They said, there was no negative unemployment, therefore not a recession.
Yeah. So again, calling a recession is actually a very complicated metric of multiple indicators. There's always been this soft rule of two negative quarters is a recession. That's just a soft rule that economists use. As an economist, we know that there's a lot more math involved in other things. And you're right, it was the job market that allowed them to say it wasn't a recession. But we still had two negative quarters of GDP growth. But yeah, you're correct. The job market was strong at the time. Unemployment was 3.4%. Folks, you don't have a recession at 3.4% unemployment. That's just not how it works.
So if you're hoping for those rate cuts, one of the metrics that you could be watching and should be watching is unemployment. All right. When we spoke last week, there was an interesting question about debt versus net worth. You went on to talk about how net worth's kind of a vanity metric that a lot of people talk about, but it's really not that important. Duncan Holmes followed up with a question. He says, he asked you about your millionaires. Does anybody know what the average ratio of debt to net worth is for Mike, you, and the investors he features on his channel? I figured you and I could talk about our personal debt to net
Yeah,
worth.
so I remember that question because he went into the fact, I think the closing line of that is he assumes some of us are 90% leveraged,
Right.
something like that.
Yep.
And I don't know any millionaires that are 90% leveraged. That's a recipe for disaster. And back to my comment about net worth, it's a vanity metric that could disappear. I've known people that were worth 10 million bucks to go bankrupt because the market turned. Um, I think I said in my comment back, I can only speak for myself. I think my LTV is like 40%, something like that. Um, so, again, I could be at 40% today because I'm done rapid growing. If I was in growth mode, I was usually at 80% LTV. So again, I think there's a point in time where you're growing on purpose with focus and you have a job, right? Day job. And there's a time when you kind of step back and you're like, oh, I guess I don't have to work anymore. Let's de-risk this. So it depends on where you are, but yeah, I mean, I think what this guy was getting after was we're all max leveraged and we're just a house of cards. Dude, you're not a house of cards at 40% LTV. So it is what it is.
Yeah, I think it's honestly difficult to be worse off than 80% LTV with real estate because most of these banks aren't even going to let you take a loan out on something that's
Exactly.
higher than 80% LTV. It's almost impossible to do that. So, I mean,
Correct.
unless you just literally put it all on a credit card and you're just running credit cards, which I've heard some gurus run that strategy. But
Yeah, me too.
for me, I teeter between like 50 and 75 because I buy a couple properties cash
Yeah.
and then I remodel them. But then once I complete the BRRRR process, well, then now I'm 75% on that property. But that's kind of where I'm hovering in. So if you want more of your millionaires, I would just leave that comment or leave that question in the comment section of their video. See if they respond to it.
Yeah, most of them will, I would assume.
Yeah, Lumberjack, Dion, Beth, they all certainly go through and answer comments on their videos. I've seen it many times.
Mhm.
All right, Mike. Bitcoin's going crazy right now.
Yeah.
Bitcoin is insane. Okay. It went all the way up to like 73,000. Right now it's down at like 67 or 68. But
Mhm.
you famously, a few years back, went 1% of your net worth into cryptocurrency. So the
Mhm.
question from the audience to you is, well, how's your portfolio doing right now? And when did you get in at?
So I got into Bitcoin at 19,000. This is, I think it was late 2018. I got into Ethereum at like, God, I don't even remember a little bit. So I'm up a lot.
Attaboy. Yeah, we can't talk specific numbers, but just knowing where he got in, you guys can imagine what 1% of his net worth might have been. I'm sure Mike's doing just fine when it comes to
Doing
crypto.
just
Mike,
fine.
any thoughts or ideas as to why it spiked up randomly out of the blue?
Well, I don't think it was random. I think you had ETF approval, and then we had BlackRock. BlackRock folks put $10 billion to work in 9 weeks. If you know anything about at least Bitcoin, which is the one that they're playing in, there's only like, I don't know, 600 or 700 coins created a week or whatever it is. And you don't get to 10 billion unless you buy from hodlers, and hodlers want to get their money. So, um, yeah, it's not shocking. The Bitcoin ETF even surprised. I knew it would be good, but I didn't expect BlackRock to throw 10 billion down in 9 weeks. I mean, just so you have scale, the gold ETF, GLD, was the fastest ETF to 10 billion before Bitcoin. It took gold 2 years. It took Bitcoin 9 weeks.
Dang. Yeah. 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 But what Bitcoin's doing right now is impressive. And we've got a halvening coming up soon, which is where the production of those Bitcoins you talked about earlier, the weekly production, is actually going to get cut in half. And historically, that has contributed to the price going up. So we'll see what happens there. All right. Now we got time for.
But one more thing on Bitcoin. Just, I still believe, and what I actually think is happening is there are more people like me, old timers with 7, 8 figures net worth, making the call to put 1 or 2% of their net worth in. None of us are putting in a number that's going to kill us if it goes to zero. It would suck. It would always hurt to lose 1% of your net worth, but it's not going to ruin you. We're just making an insurance policy. Even though I'm up a lot, it's nothing more than an insurance policy. I'm not adding, not selling, no interest in either one. It's just an insurance policy. Someday, decades from now, I'll cash it in, or it'll go to zero, and I won't care either way. Just what it is.
So recently, when I was on my trip to Indiana, because again, for anyone who's not aware, I am the king of Gary. When I was on my trip to Indiana, I was hanging out with All Nighter Hider and my real estate agent, and we decided to sit down and watch a financial movie. We watched a new movie called Dumb Money. The point of the money.
That
you
was
seen
good.
it? Okay. It was pretty good, right?
Yeah, it was pretty good.
Yeah. So my question for you, fun question for the day. What is Michael Zuber's #1 favorite financial movie of all time? Things like The Big Short, The Wolf of Wall Street. What's your favorite financial movie that everybody should watch?
Oh, it's the one where Charlie Sheen is a stock trader.
Wall Street?
Wall Street. Yeah.
With Michael Douglas, right?
Michael Douglas. Yeah. Michael Douglas. And then young Charlie Sheen. I watched that movie like, gosh, I want to say I was like 15 or 16 when it came out.
Okay.
That movie was like, I like this game.
Yeah.
That was fun.
That's funny. I think mine is The Big Short, and that is the girlfriend test for me. If she can sit down and watch that movie and keep up with what's going on and be somewhat interested with it, I'm like, that's quality material right there. I could see a few more dates with you. All right.
Wow,
all right.
That's quite the test.
Okay. Back to the topic at hand. Questions from the commenters. And this one is one that you probably haven't heard in forever. Nobody ever asked your opinion about it. It surprised me. That's when the housing market's going to crash. So Bitcoin Man 9202 says the housing market will crash. I don't know when, but it will be in the future sometime, eventually, one day. That's a fact, but who knows when. So what do you think, Mike? When's it going to crash?
The housing market will crash 3 or 4 years after we see bad lending again. We've got to get to a point where lenders do stupid things again. And we've had some legislation that prevents dumb lending, but that doesn't mean it will always be there. They could easily reverse the decision. If we get to a time where owner occupants are in mass getting 103% of purchase, getting 50% adjustable rate mortgages, 2 years or less, the market will explode higher and then explode lower. It takes something like that. So if you could tell me when we're going to start lending 103% on average with 2% or 2-year adjustable rate mortgage, half the loans, the housing market will crash 2 to 3 years after that.
Fair enough. Fair enough. That's one that I guess doesn't give us an exact date, but instead, once again, gives you things to look for. When do you see? I mean, because if you look at adjustable rate mortgages prior to 2008, at one point, they were almost 50% of all loans out there.
Yeah, 2006 was the worst origination when you look at vintage, and 51% of loans were ARMs. Many of them with a toxic neg am, which means you're not even paying the full debt. You're adding debt with every month. It's stuff today that's illegal, but we could do it again.
All righty. Now, this is an interesting question. This is a philosophical question about the education system. You and I have talked before about how we have a lack of financial education in our school systems and how the education system is broken. But Billy Buchanan, 385, says the education system set up by the government itself is the problem that you are suggesting needs to be fixed. But it works exactly as it was intended to do. It's intentionally broken because they want to create employees. What do you think about that?
Yeah, I think there's a lot in that. I might take a little caveat with kind of the venom in that comment. I think there was a time, when the education system was put together, we had to get people off the farms into companies, into manufacturing, and we had to have some base level. So I don't think the intentions were evil, as this person kind of alludes to in the beginning. I certainly agree that the system hasn't changed and it is stuck in old way of thinking, and it's operating how they want it today. I totally agree with that. I don't think it was a intentionally evil day one. It certainly morphed into something that is not helping the masses today. I agree with that entirely. Um, I just don't agree with the first. I think the first we were taking farm boys and turning them into, something else. So yeah.
Yeah, you're taking the at one point in time, 50% of Americans' job was agriculture,
Yep.
and you're turning them into manufacturer workers, which was a pathway up
It
the
was.
economic classes. So,
Yeah.
but like you said, at some point, graduating high school and getting a job and retiring 30 years later with a pension went away, and that point was like 50 years ago.
Mhm.
And over the last 50 years, the cost of education skyrocketing, the benefits of having a degree terrible,
No,
and
yeah, but I couldn't agree more. It's all broken. We need a hard reset. It's broken, 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 broken.
right. Okay, last question for the day. And this one was another interesting one from one of the commenters. He says that there's really no good time to buy in the last 2 years. So you did an interview with Graham Stephan, who said that when he first started buying, he was buying at 30% of the cost to build just after the recession. There was pretty much no way he could get hurt because there was so much upside. But he then finished that statement off by saying that he hadn't seen that in the last 2 years. Scorelord Gaming 9993 says, I've been saying this for 2 years. Now the same properties that I lost bidding wars on are back on the market. Turns out a 5 to 6 cap with downside doesn't look very good when even treasury bills pay 6%. Who knew? So what do you think, Mike? Has there been no time to buy in the last 2 years? Treasury bills were the better option?
Well, for a lot of people, yeah. I mean, if you're not willing to do the work, you're not willing to write lots of offers. That's what people don't realize is getting rich in real estate takes work and effort. And if you just want it to be easy, go buy treasuries. It's okay. There's nothing wrong with that. If you're happy with 5%, which will soon be 4.5, and then it'll be 4, you go do you. I don't accept that. I believe I can do better. And it takes time, it takes effort. It's never easy, never was. But I've shown it over the last 2 years. Many people on my channel have shown it over the last 2 years. I just think most people are lazy and refuse to do the daily work. And for you, go buy treasuries. Fine by me.
Yeah, I agree completely. If you don't want the tax benefits, if you don't want the depreciation, if you don't want the equity increases, if you're too much of a pansy to deal with managing a property manager or learning how to deal with tenants, if you just admit in the comments, you just don't have what it takes. Just right now, caps lock on, I don't have what it takes. I want an easy way that's not as successful. And then I'll applaud you
Yeah,
and say, enjoy
you
watching the
do
channel
you.
and being a hater.
Yeah, that's okay. You do you. At the end of the day, I think there are very few things in life that are certain. But one thing I think we've been proven over and over again is owning assets that produce cash flow for decades gets you there. I challenge you to do the math on treasuries and figure out where you get. I'll do me, you do you.
Mike, that was all the questions that I had for you this week. And for those of you guys out there watching, if you want your question or your topic covered, send me a message on Instagram, leave a comment in one of the videos. I check the shorts, I check the long forms, I check Instagram. Leave a comment somewhere or send it to me, and we'll make sure that it gets featured here. And the comment can even be controversial. We'll still talk about it.
I still can't believe you do that for us every week. You're amazing, man. Thanks again.